We are literally less than 24 hours from probably the biggest day of the year, or at least the biggest day of August
August.
trading. So I want to bring in Mr. Jim Welsh to talk about the biggest event of the year, Jackson Hole, and having Powell, let us all know that rates are going to get cut at least three times, and he should say that right up on the podium, shouldn't he?
I think he'll lead with that. He won't even say good afternoon or good morning. Yeah, we're gonna cut
We're gonna
and
cut.
cut
Drop the
and
mic.
cut.
That's it. That's it.
Yeah,
Mic
and
drop.
then drop the mic. Like in 2022, I think his talk lasted 7 minutes, maybe, and it
Yeah.
was kind of like we're hiking. Goodbye. you
Right.
know.
So
Um,
this is the thing, and I know you brought some slides, and I want to talk to you about this. The market's pricing in, and the market's coming in with the assumption that he's going to open the door for September cut. I mean, that's what everybody's thinking of. I'm still in the camp, Jim, that inflation is not contained, and they're still trying to put the toothpaste back in the toothpaste tube, and they're having a difficult time doing it. And then you talk about the nonstop trolling that the Trump administration and President Trump specifically. I think it's working against them in this whole situation, and I'm fearful that the markets are expecting way too much out of Powell here tomorrow. I want to give you then this that we timed this perfectly as far as the recording goes, because a lot of people are going to be watching this before his speech. So let me ask you, what are you expecting tomorrow?
well, I think you're right, Blake, and the way you frame this is I think Wall Street has unrealistic expectations that he's going to tip his hand regarding September. I don't think he would do that under normal circumstances, and these are hardly normal circumstances. Again, the minutes that were released from the last meeting show that there's a clear debate going on within the FOMC with a couple people, Waller and Bowman, in the camp that the Fed should have cut in July. But an awful lot of people are like, hey, inflation, as you noted, is above the target and heading in the wrong direction, and so forth. So I think there's almost zero chance that Powell is going to provide any hint of what's going to happen at the September meeting, because I think, in all honesty, he doesn't know. I think a lot of the FOMC members are waiting. Got another employment report, I think, out on September 5th.
Yeah.
There's another big revision coming from the BLS on September 9th. And you then have the August CPI report that'll come out maybe on the 12th, which is all before the meeting on the 16th and 17th. And so I think there's so much non-clarity that for most of these people, it's like a game time decision after they get some more data. So to the extent that Wall Street is looking for guidance regarding, what Powell will say, as I noted in this week's weekly technical review, I kind of spent a fair amount of time regarding Jackson Hole for obvious reasons. And here's the title: Labor Markets in Transition, Demographics, Productivity, and Macroeconomic Policy. As I noted, the topic isn't will the FOMC cut at the September meeting. So he's going to stick to the topic, of course, which has nothing to do or very little to do, maybe tangentially, to what they're happening in September. And instead, he's going to be talking about the macroeconomic policy, and he's looking at drivers like demographics and productivity. And that's where he's going to spend most of his time. There's
Right.
a
But
chance he might reference, the independence of the Fed as being integral for not just the Fed, but all central banks as part of macroeconomic policy. But again, I think you're right. If Wall Street's looking for a hint or guidance and they're going to be disappointed, my assumption, and when I look at the charts when we get into them, I think the dollar's poised to go up. Treasury yields like they want to go up. The dollar, I think, or the gold is on the cusp of a breakdown. And I think the stock market is ready to weaken more. So just looking at the charts make me think that whatever he says Wall Street isn't going to be satisfied.
Well, we're going to get to those charts in just 1 minute, but can't, I mean, Wall Street's looking through this. Obviously, he's not going to just signal, "Hey, a cut's coming," but can he give? I mean, it's going to boil down to was his messaging a little bit more hawkish or dovish, right? I mean, that's what it's going to boil down to.
Well, if you're expecting him to give some hints, if he doesn't give them, you're going to probably be inclined to say, "Wow, that was more hawkish because I was expecting hints."
Right. Right.
So, again, expectations I think are misplaced, which then sets the table for people to come up with the wrong conclusions. I mean, if
Yeah.
you go in there not expecting anything, you're not likely to be disappointed one way or the other.
All right. Well, it's tomorrow's going to be a humdinger. I've already actually taken all my dollar. I was long the dollar this morning. I took it off. As people in my community know, I took it off because I didn't want to have any exposure to the dollar just in case. But
Yeah.
I think you got to be ready to act tomorrow. And I know a lot of you are watching this ahead of Powell's testimony. So good luck to all of you, and Godspeed, Jim. Godspeed. The next chart you brought, you talk about the labor market, and this is going to be one of the things. Obviously, the labor market's this is going to be a really important jobs number at the beginning of September. Actually, I don't think it's on September 1st. It's going to be on September like
September 5th, I
5th
think.
or something. Yeah,
I
yeah,
think.
yeah. So first
Um,
week of
well,
September. Tell
again,
us.
this gets into demographics.
Okay.
So again, looking at the topic of this conversation, immigration then falls under demographics because if you look at birth rates in the US, they've been declining fairly sharply since 2007. And so there are two engines of growth for GDP growth. One is labor market growth. In other words, how many people are entering the labor market? Because once they enter, they have a job, they start spending money. That's an obvious driver for economic growth. And what's happened, Blake, is that the demographics is only adding about 0.3% to annual GDP growth, which is a pretty low number. So immigration can augment that and increase it from zero point 0.3 to, let's say, zero point 0.5. But what happened during the Biden administration was an enormous increase in the number of people who were allowed to enter the country. And you can see from a standpoint in 12 years, from 2000 to 2012, it was 7.9 million. And in 4 years, it was 8.3 million. So there was this huge ramp up in illegal immigration that was allowed by the Biden administration. And then those folks went out and, tried to find work. And the next chart shows that in 2023, as they went out and found work, that meant the supply of for the labor market increased. And the household survey measures how many people are out there looking for a job. And if you have more people looking for a job than finding a job, the unemployment rate went up. And so when we talked about this a year or so ago, how the unemployment rate was rising, not because people were getting laid off, it was rising because you had an increase in the supply. So what we saw was unemployment went up. The Fed didn't react to that because they tagged it as being, you just got more people out there looking for work, and most of them are people who came into this country illegally.
Yeah.
And this is what happened. That has stabilized. And even at the increase of 4.2, the unemployment rate, if you look at the last 50, 60 years, it's way at the lower end of the range. So that 3.4 was the lowest, I think, since 1969. So it wasn't anything alarming. But now what we're seeing is President Trump is deporting people. I mean, the numbers aren't huge yet, but they're going to increase. The initial focus was on people who either came into this country from a prison overseas or had committed crimes overseas and or now committed crimes in the US because they've been here 2 years and they did a robbery or whatever it is, right? But he's also, unfortunately, going after people who've been in this country 5 years or longer, who've been working, paying taxes, obeying laws. And for me, that's the dividing line. Getting rid of people who came in illegally because but they also broke laws overseas or have committed crimes in the U.S. Hey, you want to get rid of those people. But the people who have been here for a while, Blake, who are adding to the productivity and growth of our economy because they went out and got a job, to me, there should be a different lane for those. So my take is people who've been here for 5 years or longer, or whatever the window should be given an extended, if you will, green card where you can stay in this country, keep working, keep raising families, and all the rest of that. The idea of voting and citizenship, that's a separate issue. Let's take the cloud over a lot of workers' heads that have been here and being model citizens, if you will, and give them a path where they can go to work tomorrow and not worry that a truck is going to show up and yank them out of the field or the factory or wherever else they're working.
Yeah.
So that means though this influx of supply that happened now is being reversed. And as labor supply tightens, perversely, the unemployment rate could actually stay the same or go down. And it also means if you have less supply of labor, wage growth potentially, I think year over year is around 4%. And instead of continuing to come down, it was over 6% 2 years ago, 6.2 or 3.
Sure.
It may hold there. All right. So there's implications for the immigration policy. And, the bottom line here, job growth will probably shrink, but we're near full employment. And therefore, you don't need 120,000 to 150,000 workers to absorb the supply of labor that's coming in. Is probably closer to 60 to 80,000. So my point is understanding the dynamics in the labor market is critical for the Fed as well, because should they get alarmed that the only 65 or 80,000 people are joining the labor force, maybe not as much as maybe they would have been certainly a year and a half ago. So to me, this is the challenge that the Fed has been facing and will continue to face is the immigration policy, did a 180. All of a sudden, we're letting 10 million plus people into this country, and now we're starting to remove them. That just complicates the Fed's job, I think, in terms of where are we really? And the other point I'll make is that job revision on September 9th. I can't remember exactly. I think it's through March of this year. So I think it's from April 1st of last year to March of this year. And it's going to show anywhere from 500,000 to maybe 900,000 fewer jobs. And oh my God. But I've been thinking about this. Okay, even if that's the fact, has the economy, is it weakened or weaker because we get that information? Not really. So I think there's a tendency to overreact to these numbers because the last revision we said, oh my God, over 800,000 jobs just disappeared, blah, oh my God. But, the economy's been humming along without those jobs.
Yeah.
So why should the knowledge of that all of a sudden mean, oh my God, the sky's falling? And I think, again, when that revision comes out, it very well, if it does show 500 and 700,000 jobs were, penciled away. And again, the birth death model that we talked about is, I think, one of the primary culprits. I'm not sure that that should automatically convince members of the FOMC that that immediately means the economy's going to be weaker. Well, those jobs weren't there, and the economy hasn't fallen off a cliff. So.
So do you blame it on AI? I mean, is AI going to be a problem here? Isn't that was just
Not
your lead
well,
in?
it might be, but two things. I think when he talks about productivity, because that's part of the topic, the issue of artificial intelligence is going to come up. And what we can see is that from 94 through about 2002, off on the left-hand side over there, you can see productivity got above 2% and then stayed above 2% continuously. And what happened, Blake, was all of a sudden handheld devices became real. So you could have people out in the field taking measurements of whatever it is they're working on, sending it back to the mainframe. The mainframe then would spit out an answer without the person having to go back and forth. that was one of the things that really drove productivity as that technology became accessible and then widespread.
Sure.
And then after that surge, you can see productivity kind of flatlined, plus or minus around 1 to 1.5%. So again, GDP is labor market growth plus productivity. And for a long time, productivity growth was less than 2%. So when you add those two components, that's why the Conference Board's long run economic GDP projection is 1.8. They're just taking those two numbers, Blake, and putting them together. All right. At the end of last year, it was up to 3.3. Nice. All of a sudden, the first half of this year, it's 1.2. So the point being is artificial intelligence has yet to make an appearance. There was an MIT report that came out this week that kind of said only about 5% of the companies that have spent a lot of money on AI are reaping any meaningful benefits. The other 95% aren't getting a return on their investment. And so here we have the stock market been pulled up by this aspect, you
Yeah.
know, semiconductors, AI, all the rest of that. And the payoff is more likely to happen years from now, whereas valuations are at levels
Now,
where it's
their
like, oh, it could
valuations are
happen like
now.
next month.
Right, right. Valuations are now. All right. The next chart you brought is on the semis. Tell us what you're seeing here technically that has your attention.
Well, last week we looked at this chart. I noted that the RSI divergence was, pretty meaningful. I expected a pullback to 280, and it got to 281 yesterday. We got a little bit of a bounce. I think the probabilities are quite high that that 280 is going to be taken out, and the next stop is 260 to 265. And that goes back, if you look off to the left-hand side, numerous highs, 261, 263, and so forth. So I think we're going to see more weakness from the semis because I think that MIT report maybe was a little bit of cold water being splashed on the super hot enthusiasm for this sector. And it has great gains. So I think technically it gets below 280. There's going to be stops there that should see some increased selling. And if the semis break down another, what, 6% or so, 7%, I guess, maybe, I don't know. I can't, that is obviously given their weighting in the S&P. The top 10 stocks are dominated by AI, and they now represent 40% of the S&P. Ridiculous.
That's huge.
So to me, that's why I've been focusing in my letter and our comments last week, the semis, because I think they're going to point the direction of where the S&P is likely to go.
Okay. All right. Well, we're going to be keeping an eye on the semiconductor index then for sure. S&P, I've been wondering, Jim. Now, I have a different read than you for wave count because I was looking a little more longer term from the 2022 lows for 5 waves up, but you're looking from Liberation Day here, from what I can tell.
Yeah.
We have 5 waves up, so that means that it's time for a correction. Is that correct?
Well, in the green, you can see one, two, and then a one, two, three, four, five in red, which I think is for wave three. So you had an extension where you had 5 waves for
Yeah.
wave three. And my thought last week was we were setting up for a pullback for wave four. I think that blue trend line might hold, but I think it's more likely a pullback towards that 6,200 area is more likely coming. And then once this pullback is over, what this pattern says is you've had one, two, three up. This pullback is wave four in green, and that there'll be another new high coming in the S&P for 5 up from the April low and potentially completing what you're talking about from the lows of 2022.
Got it. Okay.
And if those two patterns are correct, then you're talking about a very sizable correction following that one more new high. And the other thing is, we've talked about the advanced decline line. It made another new high last week. So if we get a deeper pullback here, Blake, and the broad market doesn't perform well, and you get a subsequent new high in the S&P, and the AD line doesn't confirm it, that'll provide even more weight to the idea that, all right, one more new high and then a more meaningful correction is going to
I'm
unfold.
forecasting that we're going to see the AD line next week in Jim and my meeting. I have a feeling. All
Very
right,
well, made.
let's talk about treasuries. It looks like a tight triangle consolidation that you're looking at here.
Yeah. I mean, this morning I'm looking at and put this chart together. I said, gee, look at that. All the way last October, the 10-year was at 430. And where are we? So this has been incredibly choppy. And as you note, it's like a triangle starting to compress. My take is if the 10-year closes above 441, I think the pathway is directly up. I still think there's a chance that we'll see a drop below 418, but again, I expected that to happen this week, and obviously it didn't. If it was going to happen, it should happen sooner rather than later. So, as we've talked, my long-term outlook on treasury yields is they're in a bear market. We're going to see treasury yields move higher over time. And very, very short term, I think that 441 level, which is the most recent little spike high, taking out that downtrending green trend line, which is right around 440, I think, would also be confirmation. And if it does, the next stop should be 462 pretty quickly. So, to the extent that the bond market or short rates are anticipating the Fed to give them a bone and they don't get it, obviously that would justify yields ticking higher.
All right. Well, what does that do to the dollar? Because I know you just alluded to you see the dollar rallying from current levels. I'm looking at that exact green trend line as well. But you think we're basing and ready for a rally? And
Well, to me, there's two patterns here. From
okay.
the low at 96.37, you got to up down to 97.11, up to 100.25. And then we overlapped the high for 98.95, I think it was. So, if this is an advancing wave, the only bullish count you can come up with is a 1, 2, 1, 2. And we just finished the second wave two pullback that, as you noted, the green trend line held. This implies that the bullish count is the dollar's about to take off and blast above 100.25. The bearish count is obvious. It takes out the green trend line. If it takes out 97.11, we're going to new lows. Now, I'm biased long. We talked like a month or so ago, 2 months ago, when the dollar was nearing that low, was, hey, positioning and sentiment is so negative, the dollar, we're nearing a very important low. So that's why I think the odds favor that the dollar is about to move higher somewhat aggressively.
All right. Well, we'll see. I think I want to see how well this video ages by tomorrow afternoon, Jim. So,
How many hours before it
right,
becomes
right. All right. Let's talk
stupidly
about gold.
outdated?
Gold. You've been looking for a downside correction. It's just been really quiet. But like I said, you
Same
alluded
thing when you think
earlier.
about it. Look at back in April, we've gone effectively chopping around, and the volatility has gotten more and more compressed. So it's almost like, okay, something big is going to happen. So to me, getting above 34.03 would represent we're beginning to move to a new all-time high. And it won't take it out by a little bit. It's not going to go to like 35.20 and that's all she wrote. It'll be a much larger move. The count I favored is we're going to see a drop below 32.56, but holding above 31.27, so that you're in this choppy mess that I think is developing a triangle. And so if you get below 31.27, triangle's out the window. Above 34.03, I think the triangle's out the window. So those are the parameters. And if I'm right about the dollar getting a boost from what Powell has to say tomorrow, that would be supportive of gold getting hit.
Okay, and I mean, I think the dollar and the gold market are gonna end up being, obviously inverse of one another. So, that's what we should be looking at. And are you ready to press some buttons tomorrow, Jim?
Which buttons do you want me to push?
Sell gold, buy dollar. Are you ready to
Yes.
hit those
Yeah. No,
buttons?
I think that's the setup, and potentially sell bonds and sell stocks.
All right.
Again, a lot of people are predicating their bullishness on these various markets and bearishness towards the dollar on the Fed delivering rate cuts. I just think it's I'm still like, at the end of the day, I think they will cut in September, but it's not an 85% probability in my view,
Yeah.
because as you noted at the very beginning, inflation is comfortably above the Fed's target. And gee, you get a jobs report in early September and it shows, 100,000. All right. And as I
Right.
said, even though you get these job revisions, what's happening with the economy? So, oh yeah, oh, okay, so we have fewer people working, but the economy's still chugging along. I think the Atlanta Fed is around 2.3% for the third quarter. So, again, I think the majority of the people on the FOMC are paying more attention and weighting inflation than unemployment. Um, but they're cognizant of both. But I just think the majority of the people right now are still leaning toward not doing anything. So, but that's why they're waiting for the data. They're hoping the data provides enough clarity to say, you know what, we really do need to cut. If they do cut, Blake, the other thing I think is Powell will make certain that this was a one-off if they cut in September. We
Yeah.
don't want to have people thinking, okay, just because we cut in September, that means we're going to cut in October. No. So I think that's why I think some of the people who are reluctant to cut may eventually come around to like, okay, we can cut once, but let's make sure we communicate to the markets that this in no way means that we're going to, on a cutting cycle has begun.
Well, Jim, one of those schools of thought, and this is the other thing that I'm sure is going to be a topic of conversation, is when the Fed does eventually cut, whether it's September or ends up being October, obviously I would think before December. Usually the Fed's cutting for a reason, usually. So if they are cutting
Yeah.
rates, it's because the jobs market's really weak. That's not necessarily good for stocks. Usually it's actually they start cutting is when the market starts going down. So I think that's going to be a topic for another day.
Yep.
Maybe it might be
Yep.
even a topic of next weekend or next
You
week when
got
we
it.
talk, Jim.
All right,
Yeah.
Blake, thanks. Stay
Well,
well.
I was going to say, but before you go,
Oh,
tell
I
our
got to do a
traders how they
plug.
can follow your work and
Macrotides.com.
get your latest report.
Yeah. Jim Welsh, Macro at Gmail.
Jim Welsh Macro at
Gmail.
gmail.com. And make sure you tell Jim when you reach out to him you saw us or him on Trader Summit. And this way Jim will take care of you, right?
You got it.
Well,
Absolutely.
Jim, I want to say good luck. I'm glad we got a chance to speak before
Yeah, this worked out.
before Powell's very hawkish speech tomorrow. I'm just kidding, but you guys, Jim got this out before, so you guys can review this. And if you enjoyed it, make sure you give him a thumbs up and subscribe to this channel down below. So, Jim, thank you very much. I'm gonna look forward to seeing what charts you bring us next week.
You got it, buddy. Thanks, Blake.
Thank you. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.